FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz. The date is August 24th, 2015. We're talking to John Rubino. It's around 11 o'clock in the morning. Market gyrations, continuation of the decline from last week, and gold is holding steady. And John, hey, welcome.
Hey, Kerry. Well, I think there are a lot of wide awake traders out there this morning after the first couple of hours of trading in U.S. stocks, at least.
That's for sure. And the market was down over 1,000, but now it's come back a little bit. Is this the great anticlimax?
Yeah. Who knows? Basically, what happened was China melted down overnight. And that spread to Europe, where they had some of the biggest declines in the major European stock indices since 2008. And then it spread to the U.S. at the opening. You know, we were down 1,000 points on the Dow, or almost 1,000 points right after the opening, which was activating circuit breakers. You know, the NASDAQ traded limit down, and it looked like the Dow and the S&P were on the verge of it. And so that was the worst of the carnage, though. Since then, the market has been coming back a little bit. Neither it's, bottom fishers coming in or else the plunge protection team stepping in to buy stocks or whatever, but things have stabilized here today. But still, the carnage worldwide has been pretty horrendous. We're up in the, several $1 trillion of wealth evaporating range now in just the last few days around the world. And it's not clear what stops the process because China is in the middle of a full-fledged credit crisis right now. And we're finding out the truth, which is how it always works. After the fact is when you find out who did what leading up to the crisis. And now it's pretty well understood that China was the bubble that was blown up to pull the world out of the crisis of 2008, 2009. They tripled their debt and used the proceeds to buy natural resources from around the world in order to do the mother of all infrastructure build-outs. And so that basically pulled the global economy out of the Great Recession. But of course, it came at the cost of insane amounts of leverage in China and all kinds of malinvestment. And now that's coming back to bite them because they've got ghost cities and empty airports and roads with no cars. And, it goes on, stuff that's not generating the cash flow that's necessary to pay off the related debts. And they've also got a shadow banking system in which there's a huge amount of debt that nobody can really find or identify because it's kind of off the books. It's not part of the main banking system. And so the Chinese government is doing various kinds of damage control right now, which will probably culminate in some massive bailouts in which they use their several $1 trillion of foreign exchange reserves to prevent some big players from going bankrupt in the short run. And, you and I, Kerry, would probably say that that's a terrible use of good money. You should let the big guys, let the zombie companies go bankrupt, clear out the dead wood and start over. And that's just how bubbles have to be dealt with. And to do otherwise is to risk a lost decade like Japan has gone through, where they did that back in the early 90s. They started bailing out everybody in sight, and they never got over it. They've still got these zombie companies. And in the ensuing couple of decades, they've taken on massive amounts of debt that they can never hope to pay off. Well, China's on the verge of doing the same thing, it looks like. And, the U.S. is doing the same thing, and so is Europe. So we're all doing it, and which is basically just delaying the liquidation that has to happen. So anyhow, the world's stock markets have begun to panic in the face of what looks like a bursting bubble in China, which in turn is exposing all the fragility and malinvestment and excessive leverage in the rest of the developed world. Japan is a mess, and Europe is a mess, and the U.S. is a horrendous mess in a lot of ways. And so now people are wondering if they want to own equities. which are fairly risky, fairly volatile assets. We're finding out in the last few days, and wondering what else to do with their money. Interestingly enough, a lot of risk-averse capital, safe haven money, is flowing into the euro now, and out of the dollar. And the reason for that, or one reason for that, is that the dollar has been buoyed in the last few years, or the last couple of years, by the prospect that we would be the only system in the global economy that was tightening. We've been shrinking the Fed's balance sheet lately, and the Fed is talking about raising interest rates, and nobody else in the world is talking about that. So the dollar was extremely strong because it looked like our monetary policy was the outlier. We were the only system that was tightening. And now it's becoming obvious to everybody that we're not going to tighten, and in the face of this, is the Fed going to raise interest rates in September? Maybe, but if they do it, it'll be, sort of like Russian roulette, where they're holding the gun to their head and they're pulling the trigger and hoping that they don't blow their brains out. And the odds are that first rate hike may not cause the system to go into cardiac arrest, but a couple of future rate hikes, you're running out of empty chambers basically in the gun. And so it's highly unlikely now that the Fed tightens in any meaningful way, because to do so would risk turning this current crisis into Armageddon. You could easily see China and Europe and Japan and the U.S. all crash at the same time, and nobody have any way out of it. So much more likely in 2016, we'll see coordinated quantitative easing with all the world's central banks just giving up any pretense of normalizing interest rates or otherwise tightening monetary policy and just letting it all hang out. Just financing everything in sight, and in that way hoping to avoid a global financial meltdown. But to the extent that they succeed, if they do succeed, it just pushes the crisis further out into the future and makes it even bigger. But it would also ignite another asset bubble. So it'll be really interesting to see how this plays out, because another round of QE is totally uncharted territory. We've never done anything like this. We've never done anything like what we've done in the past few years. But let them double down from here, and who knows what happens. That's just that's a kind of Twilight Zone economy in which you really can't predict anything with certainty.
Well, will they throw good money after bad? I mean, look, China's been doing the same mistake that was done by the big banks in the U.S. in 1929. If you remember, after the crash or while it was happening, they all banded together and to try to stabilize the market, and you all know what happened after that.
Yeah. And see, that's the real dilemma for these guys, because especially China, to a lesser extent Japan, they've spent the last 20 or 30 years running trade surpluses and building up these really nice balances in their foreign exchange reserves. They have an awful lot of dollars there that back up their currency, give them a lot of flexibility. And how much of that do they want to throw at a stock market bubble, as opposed to just letting the bubble burst, let asset values go back to reasonable levels, and then work it out from there? And because this is uncharted territory, because the numbers are so huge, nobody really knows what happens now with just a garden variety bear market. Let equities around the world go down by 20%, and that might be the end of the system. We might not be able to survive that. So these guys are, first of all, clueless, because how could they be anything other than clueless to have gotten into this position in the first place? And second of all, terrified, because they really don't know what's going to happen. Their models don't work anymore. The things they've done in the last decade have turned out to be abject failures almost across the board. And so you've got classical economics telling them to let everything liquidate, and you've got kind of new age Keynesianism like Paul Krugman saying, well, we don't have enough debt. That's our problem. We need to borrow a lot more money starting now. And these guys honestly don't know what to do. They don't know which is right, in the sense that which would get them through the next election cycle in one piece, and which would lead to absolute disaster. So they are flying blind, and they're just as clueless as the average person on the street right now. So anything that comes out of the world's central banks right now has to be seen in that light, that it's just being made up. as these guys go along. So it's not adult supervision. It's not the best and the brightest making the perfect decision. It's nothing like that. It's just some guys who have no idea what they're doing, who have to make a decision because it's their job to do so. So it's going to be a mess, however it works out. But the type of mess depends on the decisions these guys make.
Yeah. Well, it's futility in motion, and these things generally have to play themselves out. There's nothing that anybody can do to stop them.
Well, apparently there's a lot you can do to delay the inevitable reckoning, because we really should have crashed and burned in 2000. When the tech stock bubble burst, we should have had a liquidation that was very, 1930s like, where we got rid of a lot of the bad debt that had built up around the world and began again from a sustainable point on the spectrum of debt and equity, but we didn't. And since that time, I think historians, when they make sense of all of this, they're going to date the beginning of the next Great Depression at 2000. That was when the system really broke down. And since then, we've been delaying the inevitable by doing crazier and crazier things with leverage and monetary policy in general. But we've never fixed anything. We've just been pushing the inevitable crisis out into the future and making it even bigger when it comes. And so I think you could make the case that the global financial system, as it was structured post Bretton Woods, after we went off the last vestiges of the gold standard in 1971, we had this really nice inflationary run that lasted till the tech bubble burst in 2000. And then that was the end of that system. And since that time, we've been trying to basically animate a corpse with more and more debt. And we're finding out that it really didn't work. We basically quadrupled or quintupled our debt, depending on the country that you're talking about, since the tech bubble burst. And we have nothing to show for it. We don't have more people working. We have fewer people working than we did back then. Average wages are lower than they were back then. The only thing that's higher is equity prices and in general asset prices. And that's basically just a function of the currencies being made worth less over time. We're devaluing our currencies, so asset prices are going up when denominated in those currencies. And it gives the illusion of a measure of prosperity, but it's a false prosperity. It is an illusion. So when it blows up, the beginning stages of the blow up will look a lot like what we're seeing out there right now. So this could be it, or we announce a global QE program and buy ourselves another 5 years, and then the blow up comes. Who knows, but basically we're just flailing around without any sense of how to get from here to sustainability. So everything you see out there is going to be an aspect of the cluelessness of the guys in charge, and it's not going to fix anything.
Yeah. Well, what can it really do? What can they do? They've tried everything, but I tend to think you're right. Another global QE2, or do we just go what Jim Rickards said and just devalue all currencies against gold? I think that's the last resort.
Well, the global monetary reset, as Jim Rickards sketches it out, is by far the least chaotic path from here to there, But like you said, we need a crisis to convince the people in charge to give up the power that they have right now to print unlimited amounts of money. Can you imagine what that must feel like for guys running a government to not have to worry about the money supply? And to them, that's probably a kind of political paradise, and they don't want to give that up. So before the world devalues across the board against gold and then links their currencies to gold, something horrendous has to happen. And we got a glimpse of it this weekend and this morning, when absolutely everything across the board falls apart and nobody has any idea what to do about it. So if this bear market, if this flash crash had continued beyond negative 1,000 on the Dow, and taken us down further. And the U.S. market had to close down because all the circuit breakers kicked in. That's a pretty good approximation of what it's going to take to convince these guys that they have to do some kind of monetary reset, that the current program isn't working. So we could still see that in the short run. And we could end up sometime in 2016 actually redefining the monetary system. That would be very cool. And it's almost too much to hope for, because I think that we have to, a grinding, chaotic period in which it's clear to everybody across the board that this doesn't work anymore, and then you just have a few outliers at the end saying, no, we need to borrow more money. When that is completely discredited, then we can do something new. But until then, we've just got chaos. We're gonna lurch from one kind of crisis to another, back and forth, inflationary versus deflationary, and so on, until the system just breaks down because everybody loses faith in the guys in charge. And this is what it's going to feel like. This is the beginning part of something like that, and eventually it's going to go to its logical conclusion, and it will be very ugly before it gets less ugly.
Yeah. So in other words, it's going to get worse before it gets better, and it's going to get a lot worse in all likelihood. What are the odds of this thing bouncing back? Martin Armstrong saying give it till October, but we're in for a correction and then it's going to reverse course. Is that possible?
Well, his take on this is really interesting, and it has the ring of logic to it, which is that the whole world is going to descend into chaos, and people with capital everywhere else are going to look at the U.S. as the last safe haven, the last place where you can be reasonably sure of getting your money back when you put it in. And so global capital is going to flow into the U.S., push up the value of the dollar, push up equity prices. And so we're going to have a very messy, very chaotic economy. At the same time, asset prices continue to go up here in the U.S., not in the rest of the world. And so his prediction is for another doubling on the Dow and the S&P. In other words, a massive blow off top in the U.S. equity bull market before it crashes and burns. And it's certainly possible that global capital decides that it likes the U.S. better than anywhere else, and that there actually is nowhere else to go. So you get the spasm of capital flows that send U.S. asset prices up for a while. It's no crazier than anything else that's happened in the last 10 or 15 years. So it's possible, which is very scary, because the normal reaction to what we're seeing out there is to just short the hell out of every major stock index in the U.S., right? When you see stuff like this happening. And you assume that the rest of the world will pull the U.S. down with it, which is what happened in 2008, 2009. But if we're going to decouple, then shorting the U.S. stock market is a really bad idea. And so it's not as clear as it normally would be what you should be doing with your risk capital, with the money that you're going to place bets with. So I wouldn't go on record as recommending anything right now to anybody other than to own some gold as insurance against chaos. That's the one thing that's holding up reasonably well lately. Gold has been pretty stable in the last few trading days while equities have been collapsing. And that's exactly how gold is sold by its backers, as something that just sits there. It's a port in the storm. You don't buy gold in the expectation of making a big trading profit. You buy gold in the expectation of maintaining your purchasing power while other things are collapsing. And so the last couple of days, the U.S. market is down dramatically. The U.S. dollar is down dramatically, and gold is pretty much right where it was a couple of days ago. So I think it's living up to its billing lately.
Yeah, I think you're right. And the question is, will it stay? I mean, really should be going up today if things were normal. But the fact that it hasn't gone down, or it's up a little, I guess, gives you some solace.
Well, compared to your S&P 500 index funds and stuff, and ETFs, gold has done really well relatively, and that's its claim to fame. It does relatively well when financial assets are getting crushed. So I think this is what we should expect from it
Do you
going
think
forward in general. It'll preserve your purchasing power. And if other things go down, then relatively you did really well.
purchasing power went up? That's what Bob Hoy has always said, that after a credit bust, the reserve currency always does extremely well. And he's been saying this for years now, since the crash. And gold and silver, even if they don't go up in nominal terms, in terms of purchasing power, they do go up. And you would think if the Chinese were major dumping gold here, we would see more of a hit here to gold, wouldn't you?
Yeah, and so far China hasn't shown any indication that it wants to dump gold. It's got dollars, so probably from their point of view, they've been acquiring gold regularly for the last 4 or 5 years. And if they've got to sell something, you would think it would be treasury bonds at this point.
They have been. They've been selling them.
Yeah. And they've got plenty more. They've got a couple more $1 trillion of dollar and euro denominated debt. So it's reasonable for them to be selling their fiat currencies and holding on to, as you said, the world's reserve currency, which is what gold will end up being in the not too distant future again.
Oh, sure. Hey, but you got to figure maybe not the Chinese government would be dumping gold, but the individuals who aren't so well heeled, who've been levered up in the stock market, they would more than likely be dumping it.
Yeah, that's the one scary thing about owning rock solid assets is that they tend to be the things that people can sell if their other stuff is crashing. And so you end up getting quality assets being dumped, not because the person who's dumping them has made a decision about their value, but because that's the only source of cash. So, yeah, we could be seeing that in the Chinese stock market. But we would also be seeing really chastened investors there who managed to get some money out of the stock market, having to do something with it then, and then looking at gold and saying, okay, well, I get it now. Stocks are not the same thing as real money. So I'm going to go back to what has done well lately and what I know is tried and true, and I'm going to, take the money that used to be my risk capital, put it back in gold. So you could see some fund flows in that direction too. So we'll see.
Yeah. Well, it would be a repeat of what happened in 08, 09.
Well, yeah, because basically the only thing that was different between now and then was that equity prices were really high now, and they'd already been crashing in 2008. So you let equity prices correct, and then let the governments of the world panic and announce massive QE programs. And we really are back in 2009 then, and that would be a phenomenal time to own gold at these levels because the amount of debt in the world has soared between those two time periods, which means we're even more leveraged than we were, and the amount of inflation that would be needed in the supply of the fiat currencies out there in order to stave off a credit crisis would just be immense. So that's a good environment for precious metals because that's the thing that governments can't create more of. While they're creating more of everything else, gold, the supply of gold is going to be stable, or actually shrinking if China and India continue to buy and hold it by taking it off the market. So that would be a good environment for precious metals, just like it was from 2009 to 2012-ish, So we could see a repeat of that, only with some much bigger percentage moves and much bigger numbers.
Hey, what about oil now? It's well under $40 today. I mean, this really does feel like deja vu all over, John. Oil really taking a hit. Commodities, copper, down in the, I think it was around 230 something, really bad stuff for commodities. And following along with the theme that you said, that people dump hard assets when they got to raise cash, it sure looks like it could be happening now.
It feels like 2008 all over again because the commodities prices that we're seeing now have not been seen since 2008. And in some cases, even before that. But at the bottom of 2008, oil was more or less where it is now. And most other industrial commodities had just gotten whacked in the previous 2 years, and they were way down. So this feels like that, and add an equities bear market into the mix, and it is deja vu all over again. So we could easily see coming out of this something very similar to what we saw in 2009, 2010, 2011. Or though, Kerry, this could be the time that people finally lose faith in the guys running the monetary system, and then QE doesn't work. If people, instead of interpreting it as a positive event, people interpret it as panic and a sign of weakness, then we get real chaos in the financial markets. And there's no obvious bottom to the price of equities in both the developed and the developing world if that kind of sense of panic takes hold in the financial markets. Because once we lose faith in the world's governments, certainly we don't want to hold treasury bonds anymore. No more sovereign debt looks good. And we would, in that kind of an environment, have to be worried about equities too. So, you could see an across the board financial crisis here where no major asset class is spared if we lose faith in the guys making the next big set of announcements. If the next whatever it takes QE announcement leads to a drop instead of a jump in stock prices, then it's game over. And the system will break down, and that'll be that. And then we'll get to talk about what to rebuild from the rubble, which will be a fun conversation, while we're still young enough to do it.
Yeah, well, the one thing is we're talking about massive change here, John, and the average person out there who just bought all the propaganda, all the garbage that the powers that be were throwing at them is totally unprepared for this, John.
Oh, yeah. And then, you got to feel for the average guy, who's doing his job and coming home and hanging out with his family and everything, and not paying excessive amounts of attention to the things that should be taken care of by the people he elected. It's not the average person's job to worry about the minutia of public policy. Although in a democracy, we should at least be familiar with the concepts that are being tossed around out there, and a lot of people aren't. So it could be that one of the lessons learned from this, from all the pain that's inflicted on regular people, is that you can't have a functioning democratic capitalist system without an informed electorate. We have no choice but to learn about this stuff and to understand what money is and understand what the role of government is and the role of the individual in a society vis-a-vis government, et cetera, et cetera. We have to figure these things out. And we can't just listen to people who say they're going to give us stuff and then vote accordingly, or we end up with this kind of catastrophe. So we don't actually get the stuff that we thought we were going to get. So there really is no choice but to understand and participate in the system as it exists. So, it'll be a painful lesson, but it'll be a useful lesson. And we might end up with a much better educated society at the end of this.
Yeah, we can only hope that something good comes from it, because you're at the mercy. Anyway, John, that's it for this week. So find John's work at dollarcollapse.com. Certainly reading the book, The Money Bubble, that he co-wrote with James Turk, would be advisable at this particular point, since there's a lot there that really presaged what we're going through now. While you're there, go to financialsurvivalnetwork.com. Articles from all over the world talking about exactly what's going on now, not what the media says. And they've been talking about it for years. And basically, you pretty much ignore it at your own risk. While you're there, sign up for the free toolkit, resource kit, webinars. You'll be signed up for a couple of free webinars while you're at it. And let's get the thing moving. John, we'll talk to you next week.
Okay, Kerry. Take care.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.